time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Canadian Western Bank, CWB on the TSX, currently trades at a price of about $24, has a $2.3 billion market cap, and a nice dividend yield of 5.3%. So Canadian Western Bank, or CWB as I will call it here, provides personal and business banking products and services primarily in Western Canada, with about 63% of its loan portfolio in BC and Alberta, as shown in this slide show that I'm showing here from their actual investor presentation. So, generally it just is a bank. They offer savings, cash management, checking accounts, as well as, business trust and trust fund investment accounts, commercial lending and real estate, individual mortgages, lines of credit, life and disability insurance products, ATM, online banking, investment products, GICs. It's a bank. I just wanted to make sure that people understand that. So moving on here to the actual loan portfolio itself. So CWB's loan portfolio consists of commercial loans and mortgages make up about 55% of the portfolio. Personal loans and mortgages make up about 20%, and equipment financing and leasing make up about 15%. Now, just for fun, I thought that I would include TD and RBC's loan portfolios as well as their capital adequacy ratios, just so that those who are watching on YouTube can kind of get a sense of where the largest banks in Canada are in comparison to CWB. So looking at the bank's capital adequacy ratios, they are all well above the requirements of OFSFI, or which is the acronym for the Office of the Superintendent of Financial Institutions. So these come in at the total capital ratio of 12.8%, which is above the requirement of 10.5%. The Tier 1 capital ratio at 10.9%, which is above the 8.5% requirement. And the Common Equity Tier 1 at 9.1%, which is above the 7% requirement. And some people might be confused. This doesn't sound like the actual requirement levels, but there was actually an update to the Basel requirements. Well, OFSI built off of the update or on the Basel requirements and is actually adding a capital conservation buffer of about 2.5%. So we're adding that on top of the normal 4.5% for common equity. Anyways, just so people understand that. Now, for a simple conclusion here, I would like to have the primary takeaway that CWB has a significant portion of its loan portfolio in commercial loans and mortgages, and its capital adequacy ratios are lower than that of both the large banks that we're looking at here, TD and RBC, which is, somewhat expected. Now, looking at the recent financial results for the company, revenue for Q1 of 2022 or 2023 came in at $272.9 million, an increase of 3% from the same quarter last year. And this was primarily driven by an increase in the loan portfolio. Now, net interest income increased about 4% compared to the same quarter last year, which reflected the loan growth, partially offset by a 15 basis point decrease in net interest margin. And the decline in the net interest margin reflects the impact of lower loan-related fees, such as payout penalties, as well as a proportional shift in the bank's funding mix towards fixed term deposits and asset yields that have lagged the growth of deposit costs through the rising interest rate environment. Now, looking at net income to common shareholders, it came in at $94.4 million, or about 99 cents per share, and that's an increase of about 8% from the same period last year. And quickly looking at the valuation metrics, it trades with a trailing price to earnings multiple of about 7 times, which compares to TD, which trades at 9.6 times, and RBC, which trades at about 12.5 times. And looking forward for growth, management did provide some targets, with loan portfolio growth expected to be in the high single-digit range, and adjusted EPS is supposed to grow in the low to mid single-digit range. So to conclude here, Canadian Western Bank is diversified across Canada, but most of its loan portfolio is exposed to BC and Alberta. The company has produced solid long-term growth in its loan portfolio, and it actually produced about 9% growth in the loan portfolio in fiscal 2022 over 2021. But CWB is quite exposed to commercial loans and mortgages, which make up over 50% of its loan portfolio. Now, the company does pay a nice dividend yield of over 5% and trades at 7 times earnings, a discount to its banking peers, but is expected due to the smaller size of the bank and geographic concentration. Now, I believe that it is a decent bank for the dividend yield, but in the Canadian banking and financial sector, we have a few other names which we prefer, two of which trade at similar or slightly higher valuations and are looking for adjusted EPS growth at a significantly higher rate than that of CWB. We're looking at actual double-digit EPS growth that these companies are looking for. So yeah, it just really depends on, the opportunity cost. And I think with the opportunity out there with better names, I think I would allocate it to those other companies that we have under coverage rather than Canadian Western Bank.
You're just mad they only have 4% in Saskatchewan.
Wow, you sound like Brett.
That's it.
Yeah.
What are they doing? Hey, they're missing out.
I don't know if they're missing out here in South.
They're missing out.
Yeah. But yeah.
No, you're right. I mean, we have coverage on one of the big 6 banks and also a mid-sized bank. And the mid-sized bank that we cover has essentially better fundamentals across the board, better growth, and trades at the same to possibly even a slightly lower valuation. I think about the same valuation, but better fundamentals across the board. So no offense to Canadian Western, but you gotta up that allocation to Saskatchewan.
Yeah.
By all means, offend them.